Hey everyone, welcome back to TakePropips. In today's video, we're diving into the world of Forex trading and looking at the top 3 fundamental indicators that can give you an edge when trading major Forex pairs. Whether you're just getting started or you've been trading for a while, these indicators are essential tools for making informed trading decisions. Now, you might already be using technical indicators in your trading strategy, but it's important to also understand the broader economic forces that drive the currency markets. That's where fundamental indicators come into play. Let's jump right into it. 1. Interest rates. The first fundamental indicator on our list is interest rates. Central banks around the world set interest rates, and these rates have a massive influence on currency values. Generally, when a country raises its interest rates, its currency tends to strengthen because higher interest rates attract foreign investment. Investors want to capitalize on higher returns, so they move money into countries with higher interest rates, increasing demand for that currency. For example, if the US Federal Reserve raises interest rates, the US dollar often strengthens against other currencies. On the flip side, when interest rates are lowered, the currency usually weakens because lower returns on investments make it less attractive to foreign investors. Now, keeping track of interest rate decisions can be a bit overwhelming, especially when multiple countries are involved. But with tools like TakePropips Trading Management Solutions (EA), you can simplify this process. It helps you stay updated with central bank policies across various countries, which is critical for fundamental analysis. This feature can also help you automate your trades based on key fundamental factors like interest rate changes. 2. Gross Domestic Product, GDP. Next up is Gross Domestic Product, or GDP. GDP measures the overall economic output of a country. It tells us how well, or how poorly, a country's economy is doing. When a country's GDP is growing, it's a sign that the economy is healthy, and the currency might strengthen as a result. Conversely, a shrinking GDP can lead to a weaker currency. For Forex traders, monitoring GDP reports is crucial, especially for major economies like the US, the Eurozone, Japan, and the UK. These GDP releases often cause significant volatility in the Forex markets. A positive GDP report, especially if it exceeds expectations, can lead to a currency rally. A negative report can cause the opposite, leading to a decline in the currency. Trading around GDP releases can be tricky because of the unpredictability and volatility it brings to the market. But once again, TakePropips Trading Management Solutions (EA) can be a huge help here. You can set alerts and automated strategies to help you navigate these market movements. Instead of manually analyzing the data and waiting for the right moment, the system can help you trade based on these economic indicators without needing to constantly monitor the markets. 3. Inflation rates. Last but not least, we have inflation rates. Inflation is a measure of how much prices for goods and services are increasing over time. Central banks aim to keep inflation in check because too much inflation can weaken a currency, while controlled inflation can help maintain a currency's value. When inflation rises rapidly, central banks may increase interest rates to curb it, which can then strengthen the currency. On the other hand, if inflation is low or falling, central banks might lower interest rates, potentially weakening the currency. One of the most closely watched inflation indicators is the Consumer Price Index, or CPI. The CPI measures the average price change of a basket of goods and services and is a key gauge of inflation. Just like with interest rates and GDP, inflation data can trigger sharp movements in the Forex market. If you're trading major pairs like EUR, USD or GBP, USD, inflation data from both the US and the Eurozone can be particularly impactful. And once again, managing this data manually can be difficult, especially when trading across multiple timeframes and currency pairs. This is where automation comes in handy. TakePropips Trading Management Solutions (EA) allows you to integrate fundamental data into your trading strategy, helping you make decisions faster and more effectively based on inflation trends. So there you have it, our top 3 fundamental indicators for trading major Forex pairs: interest rates, GDP, and inflation rates. By keeping an eye on these indicators, you'll have a much better understanding of the forces driving currency values. And remember, combining both technical and fundamental analysis can give you a more comprehensive view of the market. But here's the thing. Keeping track of all this data and reacting to market movements in real time can be overwhelming, especially if you're managing multiple currency pairs. That's why tools like the TakePropips Trading Management Solutions EA are so valuable. It helps you automate your trades, integrate fundamental analysis, and even protect your account with built-in risk management features. Whether you're new to trading or a seasoned pro, using a tool like this can give you a real edge in the Forex markets. If you want to learn more about the TakePropips Trading Management Solutions EA, make sure to check out the link in the description below. It's packed with features to help you optimize your trading and make smarter, data-driven decisions. Thanks for tuning in to TakePropips. If you found this video helpful, don't forget to like and subscribe for more trading tips and strategies. And drop a comment below. What fundamental indicators do you pay attention to when trading Forex? I'd love to hear your thoughts. Catch you in the next video, and happy trading.